Now, Indian stocks saw a historic rout, especially the tech sector hit hard by weak earnings. The Nifty Tech Index crashed 10% last week, raising 5 weeks of gains and triggering a historic rout that analysts warn is far from over. Earnings from major companies further shaped the market trajectory, particularly within the tech sector. Disappointing results and muted outlooks from the key technology firms triggered a broad-based sell-off in tech stocks. The Nifty Tech Index wiped out 2.5 lakh crore rupees, or that's about $26.6 billion in market value this past week. Now, that was the steepest weekly decline since March 2020, when the COVID-19 pandemic sent the index tumbling 13.6%. While some major firms in the tech sector now trade close to their 5-year lows. Domestic stocks began this week on a positive note, but benchmarks saw sharp declines amid a mix of global and domestic pressures mid-week onwards. By the end of the week, the Sensex tumbled below 77,000 points, while the Nifty 50 slipped below the 23,900 mark. Early optimism faded quickly as rising crude oil prices and persistent foreign institutional investor outflows weighed heavily on market momentum. Beyond earnings, the broader tone of the market pointed to relative weakness in Indian equities compared to global peers. Elevated valuations coupled with macro headwinds such as rising oil prices and tightening liquidity conditions have made investors increasingly cautious. The sustained selling by foreign investors has added to the pressure, signaling a shift in risk appetite. JP Morgan downgraded Indian stocks and sharply cut its targets for the Nifty. The brokerage reduced its base case year-end target to 27,000, marking a 10% downgrade from its earlier projections of 30,000 points. This recalibration reflects concerns over stretched valuations and less favorable risk-reward balance in the near term. Now, earlier we were joined by Mitali Nikor, who is an economist and founder of Nikor Associates. Listen to what she had to say about the recent uncertainties in the Indian markets.
That markets will react a bit negatively because at this point in time, there are too many global cues that are going against the Indian markets. What we are starting to see is that, of course, in the larger picture of the war and the uncertainties in the global markets, emerging economies are being downgraded, not only India. Indian rupee has, of course, been one of the worst performing currencies, and that's again not because of any fundamental structural issues with the Indian economy, but rather because of the fact that there is a heavy dependency on oil imports from the Middle East that India has, and that's more of a risk exposure that the markets are reacting to. Investors, it's a tough time. There's no other way of saying it because, today there is a war. Tomorrow, yesterday there were tariffs. Today there is a war. Tomorrow we don't know what's coming. And, the president of the United States has just survived another assassination attempt. So the kind of, volatility and uncertainty on the economic side and on the policy side is deeply impacting, equity markets. So at this point in time, I think for retail investors, the only choice is to look at a longer term horizon.